Hi, welcome to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me. I'm going to be reporting flows for the week ended November 7th, 2012. Might surprise you to learn that the conventional fund business gained $37.3 billion net new money. And again, that's in the conventional funds. We're not looking at the ETFs, although we'll talk off and on about that number. And this is after we heard about, first of all, up and coming presidential election, the fiscal cliff that's been hovering over our heads for quite some time, and of course, European debt issue that just won't go away. Interesting enough, we saw some good news. Basically, we saw consumer confidence come in very well. We saw the Chinese PMI come in well. And we also saw the ISM Manufacturing come in strong. But really what was looming ahead of us was the idea of presidential election and the uncertainty of the fiscal cliff. Well, certainly after the president was elected, we saw that on Wednesday the Dow took its worst one-day dive down 312.95 points. So the Dow just got crushed on Wednesday. And really in the follow-on days we've seen downside performance. But overall, we're going to tell you a little bit of story about some stuff we saw. People making bets on the presidential election. We think this is kind of interesting. Before we get there, let's go ahead and talk about our macro classifications. We saw about $900 million of net new money come into equity funds. So really kind of a surprise considering the market got crushed during on Wednesday. Returns weren't all that bad. We'll see that in a second. Taxable bond funds took in a really nice number, $4.5 billion net new money in there. Muni bond funds were all up as well, a little bit less than $900 million. And then the big story here, again, people sitting on their hands, money market funds took in $31.1 billion. That's a big chunk of change. But again, people were very indecisive. But we saw that again, there was bets on each side. So when we're going to talk about a little bit about the bet, there was bets made by Romney on the equity plays. And then when we get into the fixed income plays, we actually saw bets being placed on President Obama. And they were kind of interesting, the outcomes that happened. Equity funds overall lost about 0.68%. So despite this huge drop that we saw on Wednesday, really it turned out for a week's worth of trading at the end of Wednesday down 0.68%. We saw about $900 million in net new money come into there, but it's the first week in four that we actually saw net new money come into this group. Domestic equity funds saw outflows about $640 million, while non-domestic equity funds saw about $1.6 billion in net new money come into their coffers. This is the sixth consecutive week that the non-domestic equity funds have been taking in money, and really the big story here has been emerging market funds. Emerging market funds took in about $900 million on their own. International equity funds total packaged in about $1.4 billion, so that was good numbers. But when we take a look at the equity side, I want people to remember that we've talked a lot about this. Equity income funds did see some positive flows as well, about $276 million in net new money into equity income funds. But here's where the story gets interesting. Basically, we saw a lot of people making bets again. And if you think that Romney was going to win, you put money down on the equity funds. And we saw people do that in our equity ETF section. If we take a look there, we saw $4 billion in net new money come into that group. Second consecutive week that monies came into their coffers. IJH at the very top, iShares Core S&P Mid Cap Fund took in $1.1 billion. And on the opposite side, we saw the iShares Core S&P 500 lose about 750. So really what it was is someone was out there making concerted bets, at the top three in that chart, the top three of those equity funds say, hey, listen, we're going to put some money to work. We don't care what it is. I'm sure they have the reason for picking the particular security they use, but they were making a bet that in fact you'd have a good return. Well, as we know, actually the markets got crushed and they're probably licking their wounds right now. But if we take now a look to the fixed income side of the arena, this is where the story becomes a little bit interesting. On the fixed income side, for the 22nd week out of 22, we saw inflows, $4.5 billion net new money. That's a good number coming into their coffers. Second week in three, however, that we saw downside performance. They were only down 0.01%, a basis point, not a big deal. Take a look at it. Corporate investment grade debt funds took in $2.3 billion, so investors were still looking for yield. And it's the 21st consecutive week that we saw that type of behavior. And flexible portfolio funds saw about $650 million of net new money come into their coffers. For the 13th week out of 14 weeks, we've seen that. So investors were looking for a little bit of yield action here. But on the flip side, when we take a look at of the equity ETFs, the fixed income ETFs, we saw where this dilemma was playing out. Investors on Thursday and Friday, we took a look at the ETFs, actually injected money into, basically the treasuries of the ETFs, making this bet that in fact we would see a drop in prices and a drop in yield and an increase in prices. That's exactly what happened. But before I continue on, iShares Barclay 3 to 7 year Treasury actually took in about $1.1 billion. It's a big chunk of change for it to take in. And then on the next side down, we actually saw that the corporates actually weren't doing so well. We said like the AGG, HYG at the bottom hovering around, but it was not a lot of money. But here's where the story was. So we saw that the treasuries were actually sitting at a certain rate. I think it was about 1.75. We saw them lose about 13 basis points in 3 days. That's a huge chunk of change. When it turns around that they drop 13 basis points in 3 days, whoever made that bet actually got a nice little chunk of return in just a 3 to 5 day period. So that was a really nice return. Well, let's take a look at the muni markets. The muni bond funds actually had a good week as well. We saw for the fourth consecutive week that they had positive returns. This week was 0.31% return, and it was the 29th and 30th week that we've actually saw net inflows to this group. $847 million came into their coffers, and surprisingly, it was all national muni. In fact, we know that the single states actually lost some money because national munis took in $889 million. So obviously, we had the single states handing back some money, and this has been a story that's been going on for quite some time. Obviously, people are going to be very concerned going forward because one of the areas that they thought they'd cut would be in making municipal debt funds tax exempt. So this is going to be an issue we'll keep an eye on as we go forward. Well, the next group we're going to take a look at is money market funds. And money market funds saw $31.1 billion. Again, this was investors sitting on their hands watching everybody else do the work, I guess, but sitting on their hands waiting to see what would happen with the elections. We'll see if they put money back to work. Where we saw the money going, and by the way, this was the largest inflows that we've seen since August 10th of 2011. So it's a big chunk of change coming in to sit on the sidelines and be put back, wait to be put back to work. Taxable money market funds took in about $27.9 billion. Of that, the breakout was institutional funds took in $25.6 billion versus the retail funds, which took in about $2.3 billion. And on the tax-exempt money market side, we saw about $3.2 billion. A net new money entered those coffers. So we'll have to see what happens to this money market fund. If you recall last week, Matt told us that we saw about $6 billion in outflows last week. Certainly the $31.1 billion in net new money coming in this week offset that completely, but we'll see if they want to put that back to work. What's going to be interesting is over the next several weeks as the Congress gets together and tries to work collaboratively to solve the fiscal cliff. This will really be dependent on what's happening. Right now the markets are, I won't say on a free fall, but they're certainly not doing that good. We've had some on and off again news, and certainly people are keeping an eye on earnings reports as well. If those improve, if we get an inkling that Congress is going to put things back together, we could have some pretty interesting weeks ahead as we enter the fourth quarter. And actually, if they decide not to, we could have some very interesting on the downside looks at what could be going on for the next quarter as well. Well, if you want to do a deeper dive and check out areas that we did not cover today, you can go to lipperusfundflows.com and do a deeper dive on yourself. If not, you can join us next week where one of the analysts will talk to you about the flows trends for that week. Thanks for joining me. My name is Tom Rosine, wishing you the best in your wealth planning and creation.